Hello, my friends, and welcome once again to this edition of the Master Your Money video series that we do. We bring the best of Wall Street to you in the hopes that this knowledge can help propel you down a journey of better financial situations. I am once again joined by a dear friend, the principal of Superstock Investor, Quantitative Partners, and the new WallStreetRebel.com, who for many, many years has not only been making his own money on Wall Street, but he's been helping institutions like the big hedge funds make money, and now he's turned his attention to you. So Geoff, welcome once again to this program.
Hey, thanks for having me.
You know, we have been in an interesting market. The Fed continues to bluff about raising rates, but they don't want to, and everybody who keeps singing the death of the market's being humbled because it keeps going up.
Kind of, maybe, sort of, not really though. I mean, look, we peaked on April 20th, and now we've been kind of correcting, and we haven't had a very big correction. It's been about 3%, but we're now at. I mean, if we bottomed on yesterday's close, so on Thursday's close, since we're talking Friday night, and we need to see if that holds. But anyway, from the peak, we've come down for 29 days now, and if you look at since the end of 2012, we've had 22 pullbacks / corrections, and maybe 1 or 2 bear markets in there, and of those, 8 have been over 20 days. So this is actually, and over 30 days, there's only been 4 of them. And so we're basically at 30 days, and the pullback is not very big. It's only about 3% right now. And some of the other ones have been 10 or even close to 15%. So
I guess that's why it feels like it's going up, because it kind of went down a little bit and then popped back up near record levels, and it just sits there.
Well, what's interesting is if you look at, we broke out above 2050 on the S&P on the 18th of March.
Right.
And since then, we've gone above or below it, closing above or below it on 20 occasions out of 44 trading days. This 2050 level. We only got above 2100 for 2 days before we broke below it. And Phil calls that this up and back below 2050. He calls it the drunken crow syndrome.
Where does he get that reference?
It's just like when the crow gets drunk, it just flies around and doesn't go anywhere.
Yeah, it's just an aimless meandering about nothing.
Yeah, that's what we're kind of doing now. But within that, we've had some pretty nasty stuff. I mean, 2 weeks ago, the retailers, first Macy's, then Kohl's, then Nordstrom, they all got popped by between 15 and 25%. So you've had some pretty vicious stuff that's been happening. And what's interesting about it is I kind of equate the department stores to what the newspapers went through several years ago, where basically everyone said the industry's dead. And Barnes & Noble went through the same thing when Amazon really kind of came into their own. So maybe we're just at a point where department stores are not the way that people are going to buy their stuff anymore.
Well, we've certainly seen a transition going on there to more web-based shopping in all segments. It doesn't seem like there's a limit on either how low a price point people will do or how high a price point.
Exactly. So it's been a pretty interesting period. Hedge funds had a horrible April, and it's kind of interesting. I'll talk about this a little bit. I created a research piece, which I haven't really talked about in Wall Street Rebel or Superstock, but more institutionally, and I call it the long-short tsunami. And what happens in the long-short tsunami is basically your longs go up, but your shorts go up at a greater rate, so you end up losing money.
Is that a short-term phenomena, though, or is that a long-term loss that you're locking in?
No, it's actually something that occurs about 20% of the time. I started tracking in Phil's work how short squeezes do week to week and how names where the shorts have been correct have done. And typically, they finish the week with losses of greater than 1% about 20% of the time. The reason the hedge funds haven't had as bad a year as they've had this year is that they're typically spread out between 5. You have a tsunami week, and then everything's okay for 4 or 5 weeks. You gain back what you lost, and you gain back a little more. Then you get another one.
Right.
Well, what's interesting about this year is we bottomed on February 11th, a Thursday. That Friday the 12th, we had a good day. But for the week, it was still you still made money long short. But then the next week ended February 19th, the 26th, and then the 4th of March. In those 3-week period, you lost 11.2%. In a long short process, and then we spend the rest of March okay, and then April was another dinging where we went 5 weeks in a row of losing more than 1% in a long-short environment. So on average, it's about 20% of the time that you end up having a tsunami week. And so far this year, we're at 44. We're 8 for 19 in terms of tsunami weeks. And I haven't calculated this week, but it had started off being kind of an okay week. But then Wednesday was a horrific day where like you got clobbered on the short side of things. And then Thursday gave it back a little bit, but we were like 71 basis points. So this week could have ended up being a tsunami week as well.
Well, let me ask you this, Geoff. To what do you attribute this? I mean, we've got a geopolitical world that's in chaos. We've got an economy that's stagnant at best, a global economy that nobody knows if it's going up or down because China's hard to read. In addition, you've got the high-frequency guys now that have driven holding periods on stocks down to nanoseconds. I mean, you put all that together, is that something you think will sustain a market like this?
Yeah, I do. I think. I mean, what's so interesting about this is we've been in a broad topping formation basically for 2 years, and I saw a research piece today, which I'm going to put up on Wall Street Rebel at some point over the weekend, that looks at when you move less in a very narrow range, and there's only one other time right now that compares to the period which we've been in for being in such a narrow range, and that's 94, 95. And what happened in that period was that's when the Fed started raising rates. The bond market got totally annihilated,
right,
and then stocks actually did really well. So I actually think that the ultimate scenario here is going to be the bond market gets smoked, the economy gets better, and when the bond market gets smoked and rates go up, means stuff's doing well. They can afford to raise a little bit, and stocks take off, and we break out of this this range we've been in for a long period of time. So I actually think. I'm of the camp that we're going to see a pickup in earnings, and we've been in a earnings recession for several quarters, and a weak dollar is going to take care of that.
So if you're right and we see the markets go up, that's going to bode well for investors, but that bond component is going to cremate people who are 65 and up.
Yeah, people who are overly exposed to bonds, I think,
like target date funds and stable value funds.
They should be lightening their load right now. I mean, I literally think if we're correct on this, and I'm starting to see things that kind of make me think it's going to happen. I'm talking the end of 17. We're going to be at 2,500 on the S&P.
So you're bullish overall on the market, extremely bearish on bonds. What about commodities?
I'm bullish longer term. We still got to get through a bunch of turbulence. We have some stuff next month. We got the Brexit, which now it looks like it's shifting around a little bit, and it looks like the media has gone so negative on the Brexit that people are like, okay, we can't do it, and that looks like it's turning. So the vote. They will not leave, and so that'll solve one of the problems that we have out there. But there's still a bunch of macro problems that exist, including China, which has been really struggling since April. It's down a little over 12% since its recent peak. So, and we're down like 3%. We need to see if China can kind of get its act together here.
Right, it's going to be interesting, and as you know, going into an election year, the Fed is not historically really wanting to touch rates, but I know they want to. You and I both talked to the economics community, and there's a lot of support for a raising rates environment. I guess we'd have to see if they have the courage to do it.
Well, look, I mean, I will say one thing right now. I don't think they have the cojones to do a rate increase the week before the Brexit vote. They will look completely idiotic if somehow the Brexit happens and then the world goes into chaos and they raised rates a week before. There's no way they're going to do it. They're going to wait until July. I'll say this right now. We're probably going to get.
We're going to hold you to it.
We're going to get a rate increase in July, and that'll be it until after the election. And but the market typically does very well from June into the election, and that may play out here as well because earnings will pick up because of the drop in the dollar. And 75% of the S&P 500 has more than half their assets overseas, and revenues are overseas. I mean, you look at Intel, Coke, 80% of the revenues are overseas.
Yeah, we forget that we truly are a global economy, even here in the U.S. They may be headquartered here, but their operations are around the world.
Yeah, and we got another phenomenon that's taking place. We keep losing more and more stocks, and we keep having less companies come public. So really, there's something now like 3,800 tradable names, when before it was like 6,000. So the fact is,
it kind of does the damage to the Wilshire 5,000, doesn't it?
Supply could drop from 6,000 to 3,800, and you could actually see demand go down. but yet because of the supply-demand curve, you could end up with stock prices higher.
Right, exactly. And that liquidity issue on those 3,800 remaining companies, most of those the institutions can't touch.
Correct.
So we've shrunk the capacity.
And then to your point, the quants, I mean, a really interesting thing is I saw this movie called Money Monster last weekend. And it stars George Clooney, and he basically pretends...
that's the one where he gets the bomb guy, the threat?
Yeah, but let me kind of hit on something in the movie, which is kind of...
The spoiler alert. Here's Geoff.
There's a couple key points. I'm not going to give the whole movie away. George Clooney is basically playing Jim Cramer.
Right.
Jim Cramer or Clooney gives out advice. He gives out bad advice on a financial company, which is basically a high-frequency trading firm that's come public. In one day, they lose $800 million.
Sounds like night trading.
And basically, what it teaches you is two things. Number one, you don't listen to a guy on TV and put all your eggs in one basket. That is completely asinine and idiotic. You know, even with the stuff that we do in our newsletter stuff, I'd tell people to start off with like 10 or 20% of their assets, give our stuff a try, see how it does, and then as you get comfortable, you can expand it over time.
You know, Geoff, it's funny. I've talked to people time and time again about not managing money by headlines. You get a headline that George Soros is bullish on gold. Well, if Soros releases that information, it's because he's already taken the position.
Yeah, or he may be ready to sell when everyone else buys on his last blip up.
Exactly.
What was really interesting about this movie is that a bunch of quants all around the world kind of developed this. And I have a firm that I work with that literally has 360 quants that are in Russia, in India, in South Korea, in Iceland, all over the place. And I'm just sitting here watching this movie laughing. And like I tell my wife afterwards, I'm like, you know, I kind of live through this like day to day. And they got the quant who basically built the model. He's in South Korea. He's in a brothel, hanging out, having a good time. And they get him on the phone, and he says, "No, like this is impossible. Like I designed the math on this. It didn't lose money. Someone put their human hands on it." And that's what happens. Human beings screw up even things that are really, you know.
Geoff, I'm so reminded of long-term capital. I mean, you go down the list, right? The models that never fail.
Exactly. So
people still buy into it.
So the thing is, you just got to kind of work on process and kind of keep plugging away at stuff. And I actually like this market. I mean, we talked last time we talked. Remember, I said that I was going into more of a trading environment, and we haven't had a losing trade since we started that in May. When I said that I'm going to go more active, I've not had a losing trade yet that we've closed out. It's just been one winner after another.
That's a good feeling. And folks can participate in that if they join wallstreetrebel.com and look at the work that you do.
Yeah, we're up to, hang on, I'm just going to pull this because I calculated the numbers so far. Golden Energy's 10 winners to 3 losers for the year, and Options Index is 8 and 2. And I was quiet for a period of time, but now I'm kind of ramping it and getting going. And I have 2 trades on right now that I really, really like. I think rates are going to start going up, and I've got puts on the TLT, which for June, so we've got like 5 weeks to go on that, and I'm long the Qs calls, and the Qs are finally starting to pick up.
Are you going to go long the TBT?
Well, I'm just basically buying puts on TLT, but yeah, you could be long. You could be long TBT. You could go and do that trade right now. There'd be no problem putting that trade on. But what's interesting is there are 47 out of the 100 some stocks that are in the NASDAQ 100. 3 weeks ago, when I calculated, there were only 3 names that had a positive technical rank in Erlanger's work. Then it went to 7. Now it's 13, and the Qs are kind of getting going here a little bit. They've been dead money all year, and
you have kind of a second derivative acceleration.
AMAT today had its best day since 2008. It was up. Let me see how much it was up here. I'm just going to my machine here. Let's take a look at AMAT. Yeah, it was up 13.81% today.
Fabulous day.
Nice day for AMAT, and so I'm basically 50% invested now, and we'll see if we can. I mean, literally yesterday we hit a new low in this cycle, and then we popped back above the 2050 level. We just need to see if we can hold 2050 and kind of get going. What's interesting is the last couple of months we've not had a lot of down days, and we're at 8 days so far for the month. I'm actually going to pull the calculation here right now. And yeah, the prior 2 months were 9 and 7. So, and we're kind of actually coming into some numbers that make me think we're closer to a 2013 type year, which probably a lot of people are going to think I'm absolutely crazy. But in the first quarter, we had 25 down days, and a year ago was 35. And in 2013, the first quarter was down 24 days. This is on the S&P 500. So I really am coming to the conclusion that we're going higher, not lower. And the pain trade, by the way, is higher, not lower.
Well, then on that, Geoff, we're going to have to wrap it up for today. But I'll tell you what, folks, as you watch this, if you love talking stocks and love talking the market, join Geoff and me every week here on the safefinancial.org site. We put this out for you. You can visit our Facebook page or you can visit wallstreetrebel.com, and this video's up there. Geoff and I stand ready to serve you and bring all the knowledge we can to help you on your journey to prosperity. Geoff, I want to thank you once again. I hope you have a fabulous week ahead, and I'm looking forward to hearing if your prognostications of the future come true.
We'll see.
Have a good week, my friend.
Thanks.